So we just looked at how to calculate the current tax expense for this company, or these two companies, and now let's look at the deferred. How you calculate the deferred tax expense or benefit. Essentially, we're kind of jumping into a situation that's been ongoing for years now, and as of the beginning of the year, you have this depreciation item that has had book tax differences in tax depreciation amounts, or in depreciation amounts over a bunch of years before this year. So coming into this year, there had been $150,000 of uh, excess tax depreciation over book. So that means that in the future, that $150,000 will reverse, and the tax depreciation will be less than book depreciation in future years. So you're expecting future deferred tax liabilities to result from this. Okay, but we haven't looked at the current year activity yet. We just know that this has happened in the past, and we're expecting it to cause deferred tax liabilities in the future. Bad debt expense is the opposite. It usually gives rise to deferred tax assets, because you record book expenses by estimating what you think isn't going to be collected from customers, and then tax deductions usually come later when you actually write off accounts receivable. So when you've got um, this situation here, you'd expect to get a deferred tax asset in the future regarding this item. So you can net these two out because they go in opposite directions. So this $100,000 of beginning of the year temporary difference multiplied by 35% tax rate means that we expect at the beginning of the year we had a deferred tax liability of $35,000. Future taxes we expect to owe. Now, the way you calculate the current year deferred income tax expense or benefit is to look at the change in these items or any other items you have this year. So in this year, we had an additional $50,000 of tax depreciation in excess of book. It says that in the facts up above. And we had an additional book expense over tax for bad debts. So what we can see is a new end of the year amount that's going to be future deductions, that'll be less than book expense. And this is future deductions that'll be higher than tax expense. So in the future, we're expecting $140,000 of additions to taxable income, or once you multiply by a tax rate, $49,000 of additional taxes. So you expected $35,000 of additional taxes coming into the year, and you expect $49,000 in additional taxes as of the end of the year. So that change of $14,000 represents your deferred income tax expense. Your deferred liability, is going up. And you can also get it by coming straight down and taking these change items, multiplying by a rate, and you get the same $14,000. So you've got a current expense of $100,500, a deferred expense of $14,000, and that gives you a total expense of $114,500. In the footnote, it would look like this. Here's the current broken down between domestic and foreign. Here's the deferred broken down between domestic and foreign. There's the total expense. Here's a journal entry that you would create to record the total income tax expense, what's currently payable, and then what's going to be payable in the future, the deferred tax liability. This is how the effective tax rate reconciliation would look. Basically, it's saying 175 is what you'd expect to see, the hypothetical tax at the U.S. tax rate. So this is that book income number, 500,000 times 35%. But we know the total income tax provision is only 114.5. So the effective rate is a lot lower than 35%. And these items are reasons for the reduction. You have disallowed meals and entertainment that would add to the total provision, but then you have municipal bond interest that isn't taxable. That's going to reduce what your provision ends up being. And then you have foreign income that is taxed at a lot lower rate. Remember that Irish income is taxed at 10% instead of 35%. So that is reducing your total tax provision a lot.